Hello, ladies and gentlemen. My name is Greg Michaelowski, and this is a Forex quick look at the dollar versus Canada as it goes out at the high level for the week, for the month, for the year, and going all the way back to May 2020. Let's start off by taking a look at the weekly chart of this currency pair. And I've earmarked this yellow area right here between 137.14 and 138.548. Goes all the way back to 2014, and there's numbers swing highs and lows through that level that define this swing area. The the high price of that level comes against these lows through here near the 138.54.8, and the high price in trading on Friday reached a level of 138.36. So we are within 18 or so pips of extending into this extreme area right here and right here. These extremes took the price all the way up to 146.50, 146.66. Double top up there, close enough for those that pair. But for the most part, the price of the dollar versus Canada has been mostly between the 120 level and the 138.548, going all the way back to 2014. So being up here at the extreme might give traders a reason to lean against that level in the early part of the week. And if it can stay below this high price right here, or maybe move above and fail above that level, we could see corrective move to the downside. That is what you as a trader might look for if you're looking for a selling opportunity in this dollar versus Canada. That is also against the trend moves that we've seen over the last 3 weeks. This is the low price all the way down to 129. We're at 138, so we've moved about 900 pips to the upside over the last 3 weeks in this currency pair. So trends are fast, directional, tend to go further than what traders expect. So be careful. But nevertheless, there is something to lean against here at the 138.54 level. Keep that level in mind on the top side in the new trading week. Now, on the hourly chart, what else would hurt the bullish bias here for this currency pair? Now, if we take a look at the hourly chart, the high price that we reached in the last hour of trading here took out the high price that we saw on Wednesday at 138.32. And although the price is higher this week, it's really been in a trading range for the week, isn't it? Hasn't it? We've moved up, we moved down, we moved up, we moved down, we moved up, and then we closed the week at the highs. So not a lot of trend type action here. In fact, the market consolidated and allows the 100-hour moving average to catch up with the price, and we traded below it through here. But, you know, we're still closing high. We're still closing near the highs. We're still closing near the highs going back to May 2020. So the buyers remain in control. What would hurt that control? And if we take a look at the hourly chart, I'm going to look at the 100-hour moving average. Now, admittedly, we fell below it here. We fell below it here, 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 here. So there's a number of times where the price fell below the 100-hour moving average, but it still represents a barometer for me to the downside that if we get below, it increases it tilts the bias, at least in the short term, to the downside. That level comes in at 137.098. Remember, on the weekly chart, the low of this area right here comes in 137.148. So the 100-hour moving average, which is moving up, is near that level on the weekly chart. Kind of a dual level of support that if we get below and stay below, it'd be more bearish. The other thing that I want to point out is this trend line here. This trend line connects this low to this low, and on Friday, the low for the day came down and tested that trend line. So we have 3 spots on that trend line. That's always important. If we move below the 4th spot or the 4th support here, it's around the 136.81 level and moving higher. If we move below that level, that would be more bearish for the dollar versus Canada as well. So 1 is 100-hour moving average, 2 is rising trend line through here. The next level is this swing area right here, which comes between 136.37 and 136.66. That's going to remain static. We have a high price here. We have a low price here. We have a low price here. We have a low price here. We have lows here, 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 here. So this whole area through here is going to be another level. If we get below, that would be more bearish. And finally, take a look at the well, 2 levels. One, the 38.2% retracement. The other one is the 200-hour moving average. Both of them are at 136.00 here. Nice round number. But of course, the 200-hour moving average is moving to the upside. So that will be broken first, followed by the 38.2% retracement of this move to the upside here. This is where the price last based against the 100-hour moving average before trending to the upside. So both the 200-hour moving average at 38.2% retracement, key levels of support on the downside, that if it broken, it would increase the bearish bias for the dollar versus Canada. So those are the things that would change the bias in this currency pair. Absent that, move above the 54 level on the weekly chart opens the door for the upside, and we'll be looking at other levels, including other trend lines that were built through the week. But we know what would ruin the bullish bias on the downside, and if as long as the price remains above those levels, guess what? The buyers remain in control. So there you have it, a look at the dollar versus Canada going into the new trading week. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.